Greetings, everyone. My name is Sunil Sharma. I'm the Chief Investment Strategist at Ambit Global Private Client, here with your monthly investment strategy summary. Let's get started. So for U.S. emerging markets, the all country world earnings estimates revisions are rising significantly. And we're witnessing a kind of acceleration that we've only witnessed in the 2009 recovery and then in the 2020 COVID recovery. So it's fairly strong momentum. Now, what's driving that momentum is liquidity. 750 billion in capex announced by the hyperscalers for this year. That is largely driving the earnings revisions, which are primarily coming from tech, technology, and energy. Alongside the capex coming in from the hyperscalers, there's also 40 billion coming in from the central bank in the form of reserve management purchases, I believe is what they call it, in treasury bills. It's just $40 billion a month coming into supporting liquidity in the bond markets. And so, this type of liquidity certainly is having an impact. And one of the ways we can note that impact is in the semiconductor index, which has risen from roughly 2% of total US market cap just a couple of years ago, is now at 17.4% of total US market cap. Semiconductors and memory have been two primary beneficiaries of all this money that has been coming into the AI trade. The other notable thing, and there's lots more in the commentary, the other notable thing is the shift in central bank policy. The new Fed chairman, Warsh, came out with an op-ed in the Wall Street Journal stating that the central bank needs to acknowledge the structurally disinflationary impact of AI, and that has to be factored into the central bank's policy outlook. And that clearly translates into a mandate for growth. And I think concerns about the central bank turning hawkish would be offset by some of these comments by the incoming Fed chairman. So that's a summary of what's happening. Liquidity driving the markets. Now, a couple of things that we are noting that are cause for keeping an eye on. One is margin debt. Margin debt chart is in the piece, has risen dramatically, and the bullish fervor. So it's flipped completely from fear into euphoria. In the put call ratio data, which also is in the commentary. Looking very briefly at the commodity picture, one of the key things that has been holding India back is the concerns around supplies as a result of the war. And then, we've been consisting of the view for a few weeks now that oil would remain, within the levels that it's at, rather than accelerating higher. There's a lot of news out there about oil hitting 150 and 200. We've not been in that camp. We now see new supplies coming in. Venezuela has been shipping some 6 super tankers on the way, more on the way. US is eager to sell to India. The UAE and India have reached an agreement of strategic reserves, as well as a lot of excess capacity that the UAE will start pumping now that it's moved out of OPEC. And then Russia continues to supply India and an extension on the moratorium for a month, I believe. So all these factors are coming together to create a much better outlook for India in terms of energy, in terms of crude oil supplies. On urea, again, India is now roughly 80% self-sufficient. And with just a bit of rationing, the urea situation also is largely controllable and manageable. And so things are looking better on the commodities front, and the outlook on the macro front for India is much better. Now, separately on commodities, the commodity outlook remains healthy. There's massive global capex. So the Asian Development Bank just announced a 70 billion capex push on the infra, similar in many ways to the capex push that India has announced, which we talked about last month. And so many Indian companies could, in fact, benefit from some of the requirements that have been listed in this new announcement. The charts below for U.S. has actually started the export of crude oil out of the U.S. has picked up substantially, and the other thing that's helped is China. And I apologize for the size of the charts; they're in the commentary. China has not been buying as much crude. That also has helped the situation. On the outlook, so like we talked about, the US large cap investments, large capex investments continue to drive the AI trade, which drives the US market, which generates a wealth effect. And that has helped the economy over the last 2-3 years now. And that continues to be the primary driving force in US and, for that matter, global markets. It's notable that the Max 7 has underperformed the broader markets, and clearly the markets are penalizing the Max 7 for the very high capex outlays. So the better place to have played this is through the beneficiaries, which is Korea, Taiwan, fiber optics companies, other suppliers, as well as energy infrastructure players, many different beneficiaries. And that's been what's been happening with the markets as well. Some things that we've noted in the Korean markets that have that suggest euphoria. And as prudent investors, we prefer not to participate in scenarios such as those. So we will overweight Korea. Now we're going to take that back to market weight and remain overweight in Taiwan, as well as other parts of the emerging markets. Coming to India, the Indian macro picture, as I noted, has improved. Crude is down. That's going to help put a drag on inflation. And the RBI dividend is going to be also very beneficial to CAD. Challenges that India is facing with the gold imports, with the higher crude oil prices, which have now come down, and that should help, as well as the FI selling has stabilized. That will also help in terms of the CAD situation, and so the CAD remains manageable as it is. India's got significant reserves as well to manage any sorts of problems that could potentially come up. But things are actually improving. And then we remain positive on the massive capex push that the government is underway on, where the resources are being devoted to energy independence, defense, and private capex is also coming forward, and is also private companies are beneficiary of a lot of the money that's coming into the power sector, transmission, etc. Like I said, the FI selling has subsided, but they remain short on their derivatives positioning. Still good news that we see the FI selling has subsided, and we're not witnessing the kind of outflows. In fact, a few days, there've been buyers in Indian markets. More importantly, the earnings, particularly mid caps and small caps, the data is in the commentary. Welcome to take a look. Mid cap, small caps have delivered some stellar performance. It's broad based, and I think that is again a very strong positive for our view on the markets, which remains positive. And one of the things that we talk about this week is the constitution or the membership issues that face the Nifty 50, and we get into some of the details of why that has been a primary reason why the broader benchmark, the Nifty 50, has not delivered the kind of returns that one would expect, and has also created this perception that the Indian markets are not doing well. Our view is that they, depending on what part of the market you're looking at, there are many names that have done well. And in fact, we recommended a rotation into power, energy, defense, commodities, metals in March of 2026. All of those sectors have done extremely well. And so, we remain bullish on the India story. Should we have a ceasefire announced, then we would be more positive on the consumption space as well, and look at other parts of the market for a more broader based recovery. For now, we remain in the same positioning, awaiting news on the US Iran front. That's it for this month. Thanks for watching. Please take a look at the commentary, and look forward to seeing you next month. Thank you. Bye bye.